Yeah, Brian Weakliam. I'm the founder and CEO of Bankhawk. We help large companies to optimize their banking and payments arrangements. Okay, in our experience working with companies, the costs that they can see, they can often manage themselves. But what they've got to look out for is the hidden margins. So there's three areas of hidden margins that we see. Interest rate margins, where you have money in the bank and you're getting a poor return on that money, and the bank is lending that money to elsewhere at a much higher rate. So they're using your money to make money for themselves. And that margin is often hidden because companies have hundreds of bank accounts, maybe many banks, and it's really hard to see and manage that money and ensure there's a good return. The second area is FX, right? So where a company is trading FX and is doing deals, very often it's on top of those margins, but it's the high volume, lower value transactions, of which there are many in a large corporate. Typically the margins, the FX margins on those transactions, on those payments, is much higher. The last area that we see is B2C companies where they accept card payments. Card payments acceptance is very expensive, and there are hidden margins typically. Some of those are currency margins and some of those are hidden card fees. Typically with the large payment companies, the likes of Visa and MasterCard and Amex, those hidden costs can be quite a significant chunk of the overall cost. It's record bank profits are bad news for companies, because the more money the banks make, the more the customers pay. So the bank profits comes from their customers. For companies, record bank profits means that they are effectively paying more for the same banking service they had when the profits were lower. So unfortunately, in theory, record bank profits should, on the face of it, be a good thing, but actually it's not a good thing for companies. Okay, well, simply in two ways, right? So the borrowings obviously become more expensive. So that's a bad thing. Now, in theory, then they should be earning more on their cash. But the reality is that doesn't happen, because banks don't tend to pass on the full benefit of the interest rate rise to current and deposit account holders. So the interest rate rises are usually bad. Okay, we have a three-step process, which is audit, benchmark, and optimize. So we audit the existing banking and payment arrangements. We benchmark those against the sector and against best in class. And then we help companies to implement measures to optimize their banking and payments arrangements. Well, that's a really interesting question, because uniquely, cash in euro banks isn't covered by any official scheme, right? So in the US and in the UK, there's a clear procedure when a bank gets into difficulty that the regulators step in to protect the depositors, right? In the EU, right, deposits below 100,000 are protected. But if a bank gets into difficulty in the EU, or it fails, there is actually no resolution framework, and it is down to each individual government to decide how they address the problem. Now, it's politically unpopular in some countries to bail out banks, so it's quite likely that depositors will take a hit if an EU bank fails. Companies don't really take this into account, and they should, at a minimum, demand a good return on their cash as a kind of a risk premium, if you want to put it that way. So it's something that treasurers and CFOs should be very aware of.